I've been originating loans now since I got out of college, and I have reviewed tens of thousands of credit reports, mortgage statements, income documents, you name it. And it's very rare that I find a family in their 40s or even early 50s that have paid off a majority of their mortgage. And you have to think about it, like, why is that? Like, why? And the reason is most people don't stay in their mortgage for very long, and when they choose to purchase a new home or refinance, they start the madness of a 30-year term all over again. So let me break it down a little bit. I have a couple of numbers here on my whiteboard, right? 27% and 71%, and I have year 5 and year 15. So these numbers represent the percentage of interest collected by the bank in proportion to the interest over the entire loan balance, over a 30-year period of time, in the first 5 years. So in the first 5 years, which is 10% of the life you're paying on a 30-year mortgage, the bank's collecting 27% of the interest, right? You're paying very little principal, a majority of interest. In the first 15 years, think about this, half of a 30-year term, the bank's collecting 71% of the interest they're going to collect over the entire loan balance. After 15 years, you really start to accelerate the principal reduction. And this is why most people never pay off the loan. They buy their first property. It's generally a starter home or generally a home that's not their forever home. If rates decline, they refinance. So let's say you buy a house, you're in it for 3 or 4 years, rates decline, you refinance, you start the 30-year cycle over again. So the heaviest percentage of interest being collected by the banks, you start all over again. Now let's say you've had kids and you're moving on to a larger home. Now you're taking out a bigger mortgage, again at 30 years. And let's say you do that 3 or 4 times during your life, your adult life. All of a sudden you're 15 years into home ownership and you've bought a couple times and you start a 30-year cycle over again. You never get down to the last 15 years until you're a little bit older. And by then the kids are in college, right? That's expensive. Or you're reaching retirement. That's shocking. Nobody likes to get to that stage. And you still have a mortgage. And the reason is because most people always take on the 30-year loan and they focus on the monthly payment. And I've successfully educated many people into the benefits of a shorter term loan where you flip the script, right? You're no longer paying a majority of interest. You're paying a majority principal in the first 5 years, doing like a 15-year loan or a 20-year loan, and you're paying off the house faster. You're reaching a milestone in life where you have a majority of your home paid off by using your mortgage as a tool to fulfill your future financial objectives versus just kind of lining the banker's pockets with paying them interest over and over again, thinking that you're saving interest because you're refinanced or whatever. So if you would like to kind of have your mortgage analyzed and see what the benefits would be doing a shorter term loan, because most of the time I run these numbers, and if you've been making a mortgage payment for a while, you owe less than your original loan balance. So if you convert your loan to a 20-year loan, the monthly payment difference sometimes is very minimal, if non-existent, especially if our interest rates declining at the same time. And with rates starting to inch higher, it's a good time to actually consider refinancing before the opportunity just is no longer available. All right, if you have any questions, leave comments below, give me a call. We'd love to have a conversation.